wave theory really work? Well, I don't want to go into the absolute bits and pieces of Elliott wave itself. There's plenty of it on the website, and there's certainly plenty of it on the internet. But what I want to do is talk about how I use Elliott wave myself. And you would be receiving the free chart of the week. That's a very, very small portion of the total offering that we have at the Chartist. We run a lot of portfolios and a lot of different things. But our nightly chart research is based around Elliott wave theory, and it should be used as a research tool. So what we want to talk about here today is perhaps the peripheral parts of Elliott wave. First and foremost, Elliott wave does not make the profits. There is no holy grail with Elliott wave. It is not the be-all, end-all strategy or analysis technique. It is to some, it's not to us. And I think if anyone takes that view, it's this way or the highway, I think that's totally wrong. Elliott wave does not make the profits. It's simply a way to analyse the market, and I find it useful to do that in various degrees. Following trends make the money, and as we'll see on the next slide, the very vast majority of my trading is actually trend following trading rather than anything based on Elliott wave. Elliott wave, however, is good for bigger picture analysis. We called the 2007 high, albeit early, but we called the 2007 high to be followed by a substantial decline that came about, and in March 2009, in fact a couple of days before the absolute low in March 2009, we suggested that an imminent low was in place or about to occur, and that prices would bounce towards 5,000, 5,500, and that's exactly what's going on. So bigger picture, it does work very, very well, and obviously with that in mind, you can set bigger, broader strategies around that. Elliott wave does allow us to buy dips rather than breakouts. Every single trend will occur with some kind of a breakout. That's why breakout trading is very popular and also very, very successful. But buying dips, following the trend after a dip, can also be reasonably successful, and Elliott wave enables us to do that reasonably well. The one thing I would suggest with Elliott wave is that it's used in isolation. That is, we pick out the little pieces of the Elliott wave theory that repeat themselves and therefore can be used to build a strategy around. So it may not be that we're looking for absolute all parts of Elliott wave, but we're just pulling the pieces out that we want to look at and use those for the trading. Elliott wave, well, we don't use it on its own. We use it in conjunction with many other facets, including common sense. We use volume, support, resistance. We use divergences. We use classic chart patterns. We use all sorts of different things to build a picture. And the background or the foundation of that picture is obviously on the basis of Elliott wave. But that's not to say that we try and force Elliott wave into every single stock that we look at. We certainly don't. A good example for reference would be Woolworths at the moment. I mean, we have absolutely no interest in trading Woolworths, analysing Woolworths, nothing, simply because there's no identifiable patterns there that fit our Elliott wave theory, and therefore we don't attempt to squeeze it on there. There are a few global and in fact some very major Elliott wave purists out there that would attempt to squeeze some complex and ridiculous count onto a Woolworths chart, and we just feel that that's the wrong approach. The other problem we find with some of these bigger names out there in Elliott wave, they tend to have a macro view of the world and then attempt to put Elliott wave in and around that. That's the wrong way. You've got to look at a chart for what it's currently offering you. You don't look at a chart with the bigger macro picture in mind and then try and fit it around that way. So if you want to get into Elliott wave, the suggested reading we offer is Dynamic Trading by Robert Miner. I believe he does have a new book out. I haven't got a copy, but it's a lot more around strategy as well. But we think Robert Miner offers the best real-world application rather than pure theory. Theory's all good and well and fine, but at the end of the day, you've got to be able to apply it, and you've got to be able to do it in a rational trading sense. And Dynamic Trading, or perhaps his new book, is an updated version and would be the better way to go. So, just on my trading, this is outside of the self-managed super fund. 50% of my capital is allocated to the growth portfolio. Now that's the trend following model that we looked at before. We'll take another look at it shortly. But it has an average hold period of 10 months. It's an incredibly successful strategy, very easy to use, and it's an absolute joy to trade. So 50% of my capital goes towards that one. 35% goes to the systematic power setups, and that's a short-term strategy. Again, it's a trend-following strategy, and again, it's a breakout strategy. It's based on the turtle trading technique, and it's relatively new to the chartist, having a rough time over at the moment as the market's moving sideways, but once the market starts trending again, it'll kick in very, very nicely. So I have 35% of my capital allocated to that particular strategy. And lastly is where the Elliott wave comes in, and I have about 15% allocated to discretionary setups, which is based on isolated Elliott wave setups. So you can see, even though we use Elliott wave for the bigger picture analysis, it's not necessarily applied to the day-to-day trading. Certainly in my case, very small portion of it is. The next common question is, what is your preferred stop loss method? Well, our preferred stop loss method will depend on the strategy we're currently trading, specifically the time frame that is currently being traded. So for example, on the growth portfolio, we like to use wider stops. In fact, we've got a couple of different stops operating in the growth portfolio at any given time. We'll take a look at those next. The ASX power setups, well, it's based on the turtle trading strategy, and the rules of that strategy are out there. Again, we'll take a look at some examples of that shortly. The rules of the turtle strategy are certainly out on the internet. You can see them. I'll even tell you how we enter the stock, but there are two extra rules that we've added in that make it very, very important for success. And for our discretionary trading, we use very, very tight stops. But the one key to our success is the trailing stops. That is, following the market, trailing a stop behind the market, following the trend, allowing a trend to develop, and exiting when that trend turns. We try not to use profit targets. Yes, on occasion when we're trading with discretion, we will use profit targets, but mainly on the short side, or mainly when the market's very, very choppy. But 9 times out of 10, if given the opportunity, we'll always opt for a trailing stop. Let's just take a look now at the growth portfolio and take a look at some of the stops that we currently use. Now, this again is AmiBroker. It's off-the-shelf software. It's less than $200. Anyone can buy it. It's nothing special. It's what goes into it that makes it special. And with the growth portfolio, one of the interesting things that we do is we have an on-off switch. If you have a look down at the bottom here, you can see some red and green lines. And this is very, very important. Specifically, this period right here you can see is red, and that means the broader market trend is down, and we